Chapter 17, The Costs of Debt and Equity Capital. Introduction. Chapter 17 explores the costs of debt and equity capital and how firms raise capital. It emphasizes the importance of attracting capital by offering competitive expected returns and explains how to calculate the weighted average cost of capital, known as WACC. The chapter also discusses the issues that arise from estimating the cost of equity capital and the use of net debt in calculating WACC. Additionally, it delves into alternative sources of funds such as preferred shares and convertible debt. Learning objectives. By the end of this chapter, you should be able to 1. Calculate the weighted average cost of capital, or WACC. 2. Describe the issues that arise from estimating the cost of equity capital. 3. Explain the use of net debt in calculating WACC. 4. Calculate the required return to preferred shareholders. 5. Calculate the WACC of a firm that issues preferred shares. 6. Discuss how issuing new equity impacts the cost of equity capital. 7. Explain the functionality of convertible debt. Key points. Companies raise capital through debt and equity financing to acquire assets necessary for their operations. The weighted average cost of capital, WACC, is the average rate of return a company must earn on its investments to satisfy its investors. The cost of debt capital is determined by market conditions and the yield to maturity of debt securities. The after-tax cost of debt is lower than the stated interest rate due to tax deductions on interest payments. The cost of equity capital can be estimated using the capital asset pricing model or the constant dividend growth model. WACC is calculated by weighting the costs of debt and equity capital based on their proportions in the company's capital structure. Net debt, which considers a company's total debt minus its cash and cash equivalents, is often used in calculating WACC. Preferred shares offer a fixed dividend and have a higher cost of capital than debt due to their position in the order of claimants. Issuing new equity can impact the cost of equity capital and dilute existing shareholders' ownership. Convertible debt allows bondholders to convert their debt into equity, providing flexibility for both the company and investors. Real-world application. Understanding the costs of debt and equity capital is crucial for financial managers when making investment decisions. By calculating the WACC, they can determine the minimum rate of return required to satisfy their investors and evaluate the profitability of potential projects. This information helps companies make informed decisions about capital allocation and financing options, ensuring they maximize shareholder value and maintain a competitive advantage in the market. Additionally, the ability to issue preferred shares and convertible debt provides companies with alternative sources of funds, allowing them to tailor their capital structure to meet specific financing needs. Conclusion. Chapter 17 provides an in-depth exploration of the costs of debt and equity capital. It emphasizes the importance of attracting capital by offering competitive expected returns and explains how to calculate the weighted average cost of capital, known as WACC. The chapter discusses the issues that arise from estimating the cost of equity capital and the use of net debt in calculating WACC. It also explores alternative sources of funds, such as preferred shares and convertible debt. By understanding the costs of debt and equity capital, financial managers can make informed decisions about capital allocation and financing options, ultimately maximizing shareholder value.